So we're going to talk a little bit about technical details, some indicators, what's happening in Sri Lanka when it comes to the banking sector, and a little bit of future direction of the economy in terms of the banking sector. We have with us today Mr. Travis Gomez from the Frontier Research. He's the Vice President there, joining us once again. A very good evening to you.
Thank you, Sakuni. So what I basically wanted to just give you a brief introduction to is that, if you take the economy as a whole, one of the most important sectors is the banking and finance sector. But although it's so important, when it comes to kind of analyzing the banking sector, or the general public in general, when it comes to the banking sector, people are very hesitant to kind of try to understand that, because they use a lot of technical jargon. You take any newspaper these days, a lot of these companies are reporting their earnings. People are kind of intimidated by that. So one reason is because they kind of have their own set of jargon, their own set of technical indicators. So what I'm trying to do is just to give you like a very briefly, what does it all mean to you? And you personally as an individual, when you try to decide, okay, where best do I put my money in? What are the things, really you want to look out for?
Right, so that's great. Today we're going to talk about a lot of things, like I said, but we're going to start with the current account and the savings account. We have some figures, which we can see some bar charts. We want to take a look at that first, and you can explain what these things mean to us and how that's going to make sense.
Yeah, so if you take, at a very basic level, what the banks are basically doing is they're basically raising money from the market. They're taking your savings and basically transforming them into a way where they can lend it out further. Okay?
So these things at the bottom, it says COMB, HNB, some NDB, those are just names of banks.
Yeah, so those are basically for the different banks. And what I've basically shown here is when you're analyzing banks, one key thing you need to figure out is what are the sources of the funding for the bank? Where are the banks basically getting their money from? So if you think about a bank in general, we think, okay, there are three things where we can put our money in. You can either put your money in a current account, a savings account, or some fixed deposit. So when it comes to, from the bank's point of view, obviously the current account and the savings account, the bank basically gives you a lower rate on those things. So from the bank's point of view, current account and savings accounts basically represents a cheaper source of funding for them. So a key indicator for that is what I've shown in this graph, which is called the CASA ratio, okay, which basically shows you what proportion of their deposits are from the current account and the savings account. So because that represents a cheaper source. So in general, how you'd interpret this is that the higher the ratio, that means that the bank basically has access to a cheaper source of funding, basically. Okay. So typically what has been happening more recently is that with the interest rates picking up, basically now fixed deposits and things like that are looking more attractive. So more people are kind of moving their money out of equities or whatever other savings they have and putting them more into banks. So as a result, the CASA ratios have started to kind of decline for most of these banks. So that's like a key. So that indicates that from the bank's point of view, their cost is basically going up.
Right, okay. So that was a very great understanding, very good explanation of what's happening with the current account as well as the savings account. From that, we'd like to move on to a lending mix. What exactly do you mean by a lending mix?
Yeah, so basically the money that the banks basically raise, this is basically how they lend it out, how they transform it into loans. Okay, so if you look in slide 2, what I've shown is that for the banking sector as a whole, what are the kind of areas that the banks are basically gone into? So broadly, you would think, okay, mainly it's into these term loans, both short-term and long-term, as well as bank overdrafts. So that's the bulk of the funds are going into there. But now more recently, what has been happening is that in the past, given that interest rates were somewhat lower, banks basically started to go into these more like basically sources where they were basically getting higher yields. So a key source was in terms of this finance leasing. Previously, it was a lot of the finance companies that were doing this. Now the banks have also started to show an interest in that, because so that's mainly when it comes to this, given the pickup in this vehicle leasing and things like that, banks have also started to enter that area. So on the one hand, you're getting, that means that the banks are getting a better return, but at the same time, that's also increasing the risk of the banks. So as a result, the central bank also more recently have been kind of worried about that. As a result, they've been proposing some legislation with regard to that as well.
See, Travis, we want to sort of, through this segment, educate the public on how to understand your bank. That's why we're sort of explaining what this lending mix is. Where can we find out this data? Where can we find the sources?
So pretty much from the annual reports you can find. So the individual companies. So if you take the central bank annual report, they more or less give you an overview of the. So this chart here is for the bank, for the banking industry as a whole. But if you want for the individual banks, you can also get the same data. So you, as if you're worried about, okay, is my money safe with this bank? One possible indicator might be where you can look at an individual bank, where have they been lending this money out? Are they going more towards these high risky sectors like pawning or leasing and things like that, or are they more conservative? So that this leasing mix, you can kind of take it to as a gauge of the riskiness of the particular bank that you're investing in.
Right. So next, I want to talk a little bit about net interest margins, because like I said, this segment we're going to learn about the bank. What is the bank offering, and how can we know if the bank is a good bank? So the next indicator is the net interest margins. What do you have to say about that?
Yeah. So that basically is where it all boils down to. So in the first thing I was talking about the CASA. So that basically represents the cost of funds for the bank. Then the lending mix basically indicates, what are the rates that the bank is basically getting on the funds that they're lending out. So that net interest margin, what that captures is basically the difference. On net, basically, if the bank borrows 1 rupee from me or 100 rupees from me and it lends it out, on average, this is basically the return that the bank is getting from their point of view. So this basically represents, in a sense, the profit that the bank is getting. So more recently, what has been happening is across the industry, if you look at it, basically the net interest margins have been somewhat weakening. That's because with the pickup in the interest rates, basically the sources of the cost of funds for the banks, that's basically their borrowing cost from the bank's point of view, has been going up. So as a result, the profitability of the banks have been weakening somewhat. So this is like a very good indicator of the profitability of banks.
Right. So next I want to talk to you about the operating costs as well as the average assets of the banks.
Yeah, so broadly the first 3 things that I discussed is gives you a good indicator of in terms of the operational level. Then if you want to go a bit more deeper, you would also be interested in seeing how when the bank basically goes about these operations, how efficiently do they go about it. So one indicator of that is what I've shown here in the next slide as operating costs over the average assets. Okay, so that in a sense tells you how efficiently is the bank basically going about its work. So typically what you want, the ideal case would be where you're seeing a decline in this ratio, because that means that basically the bank is able to curb its costs. So basically when the bank, typically every year they'd go for some bank expansions, so that also indicates there's more, the number of employees are going to increase, their electricity costs, all those are increasing. So this kind of shows while the bank is going through those expansions, how well are they basically able to curb their costs. And that basically is going to add to the bottom line in terms of the bottom line profitability of this fund.
Right, so that's operating costs and how efficient the banks are in terms of how they function. I want to talk about NPL ratio now.
Yeah, so the final slide I'm showing here, which more or less is linked to the lending of the bank, is basically, so now basically as I said, on the one hand, if you go into these things like finance leasing, into these things like pawning, the bank is going to earn more in terms of they can charge higher interest on that. But at the same time, the bank also face a risk. That is the risk that basically they won't be able to recover their money back. Okay, so that's what that's what we call these certain loans you'll basically have to write off. So that's what you call non-performing loans. And a key indication of that is what's called this NPL ratio. So that's basically out of the proportion of your lending, how much of that is basically non-performing. That is, there's a chance that you won't recover it. So ideally, when you study across banks, the ideal case would be to see where to keep your NPL ratios very low, because that means that basically you are very good at recovering your losses, and that basically indicates that you don't have as much risk.
So if you just look at it, the third sort of data set, that would be the best one to invest in right now.
Yes, so that gives you, yeah.
All right, okay. So that's how NPL ratios work. With that, we'd like to thank you for being with us this evening once again, Mr. Travis Gomez, the VP, that's the Vice President on Frontier Research, talking to us about banks and how they function and how to identify an efficient bank. Thank you very much for being with us.